If you were to invest your money on planet Earth, there's really only four places your money can go. You can either put your money into companies, and those companies can either be private companies or they can be publicly traded companies, but they're companies. And for the sake of this conversation, let's just think of those companies as equities or buying, portion of ownership into publicly traded companies. We'll call that the stock market. The second place you can put your money on this planet is by loaning it to other entities. You can loan it to governments, you can loan it to companies, you can loan it to other people, you can loan it to municipalities, but you can loan your money to other entities. Most people think of this as bonds. So you can put your money in bonds or you can put your money in the stock market. And not either or, like either one or the other, but you have two places where you can put money. The third place you can put money is into currencies. You can put your money into US dollars or euros or yen or yuan. And most people don't think of investing in currencies when they quote unquote set money aside, but that's in fact what they're doing. Most of you know, if you've followed me for any length of time, know that the US dollar is down about a third on its purchasing power against other printable currencies. So clearly where you set aside your money really impacts kind of what happens to your future. But the third area where you can put your money is in currencies. And then the fourth area and the last area is something I just call physical assets. And physical assets can be houses, apartments, rare wine, commodities like coffee, sugar, cocoa, oil. It can be something physical in nature. And most of the time, people invest in their own house. And we won't go down the path whether your house is an investment or not, but that is money you have and you're placing it somewhere. So every dollar that comes into your life has to go into one of these four buckets. There is not a fifth bucket. You can't go to Venus or Mars or Saturn and invest in anything else. Like, you are stuck on this planet in investing in either stocks, bonds, currencies, or physical assets. So what I want to do this weekend is just kind of show you where money is flowing kind of year to date, and specifically the two most recognized places to put your money, which is the stock market and the bond market. And I want us to kind of look at that and see what might be coming down the path based on what's happened the first 5 months of this year. Hey everybody, this is R.C. Peck with Fearless Wealth, and this is my weekend podcast. And the theme this weekend is called Bonds versus Stocks 2014. When I was a kid, I went to go see one of those WWF WrestleMania things. It was Hulk Hogan and Mr. T back in the 80s, and they always made a really big deal. So this is bonds versus stocks. Here's what you need to know. So the first thing you need to know is on this price chart right here. This is what's called a ratio chart. It's showing you the ratio of money flowing into the S&P 500 and money flowing into long-term government bond in the U.S. Now, the way we're measuring money flowing in is literally just the price. Is the price of the S&P 500 going up more than the price of a long-term government bond? And you can see in 2013, the S&P 500 is the place that people were putting money. But since the beginning of 2014, there's been a lot of competition to the stock market. And when this line falls, as it's been falling this year, not straight down, it went straight down till the end of January, then moved up, now it's moving back down. But when this line falls, that means the price of long-term government bonds is going up. So the question is, why would people be buying more and more long-term government bonds than perhaps stocks? Or why aren't stocks going up? And that's the question I want to pose to you and kind of discuss and what we should kind of learn from that. Now, if you can look here from the beginning of the year till today, the price of long-term government bonds is up almost 12%. So if you were to put your money in U.S. government bonds, long-term U.S. government bonds at the beginning of the year, your total count would be up 12%. In comparison to if you put your money in the S&P 500, not including dividends, it would be up 1.35%. So clearly long-term government bonds is killing the S&P 500 this year. which is not even above 2%. So what does this mean? What should we make this mean, or what can it possibly mean? As the market has been trying to go higher, we just had a lifetime high on the S&P and the Dow Jones. As that's happening, people are not putting more and more money into the stock market, at least not based on the price going up. Where people are putting more money is in long-term government bonds. Not even short-term government bonds, because people are putting more money into long-term government bonds. People are putting more money into long-term government bonds in comparison then to corporate bonds or municipal bonds. So, is this because the governments of the world are buying it? It actually doesn't matter. There's competition to the US stock market. Now, my take is that as the stock market's been moving higher in a very difficult pattern. And remember, last year the market was up 32%. That's an exceptionally stunning year. That people are a little bit more scared, and when people are scared, they put it in a place where they just want their capital back, which is long-term government bonds. That means there's going to be headwind for the stock market. Now, credit is still expanding. Money printing is still expanding. But what we have to watch, and I'm going to go back to the previous chart, but what we have to watch is one thing very specifically. If this ratio falls below its January low, then that may be a tipping point where we really need to scale back our exposure to stocks. Now, it's pretty close to breaking its April low, so we're going to watch that, because that means more money will be flowing in to long-term government bonds and stocks, and that's actually an indicator and a signal that we want to watch. And what that would signal is people's concern is increasing even more, and that's going to put a lot of headwind and downward pressure on the stock market. So we're going to watch that. Now, before I end, I wanted to show you two more price charts. Kind of what's going on with the S&P. So the first one I want to show you was just comparing the S&P with small cap stocks. So the red line on the screen is the S&P 500, and small cap stocks is the blue line. Well, typically when people are getting more scared, they're getting out of the smaller companies because they feel riskier. There's more risk in being them, and they move their money into the larger companies like J&J, Johnson & Johnson, and Microsoft and ExxonMobil. And if you look at the screen, that's what's going on. Smaller companies are down. They're down 5% for the year. If that continues to fall and in fact breaks below its February low, again, that's going to be another indicator that has us go, wait a second, this could start heating up. The stock market could start moving down, and we're going to want to change our exposure. The last price chart I want to show you is, again, kind of an internal look at the S&P 500, and this is small financial stocks or regional banking stocks. Again, it's the same idea that maybe the large, too big to fail banking stocks like Citibank, Bank of America, Wells Fargo, they may be going sideways or slightly up, but there's going to be no bailout for regional banking companies. And regional banking companies are down 9% for the year. 9% for the year. Now, I actually owned in our portfolio KRE, and we got out with a profit and moved it into a different sector, actually a REIT that was paying 12%, and that move has turned out to be a really good move. But the point of this price chart is you have the overall small cap market falling down 5% of the year. You have these regional banks, which are the smaller banks in the US, down 9% of the year. So these are two warning signs, and we're going to watch. I'm going to watch to see if small regional banks break below their February low, and the same thing for small cap stocks. Those are going to be two signals for us to get much more cautious on where we have our money exposed. And the third thing I'm going to be watching is that ratio of the S&P 500 price to the long-term government bond price, because those three things are going to really tell us, kind of looking forward, kind of our crystal ball on where things may be unfolding. And in fact, if small caps and regional banks does break down, and that ratio breaks down too, we're going to want to limit our exposure to equities or stocks and increase our exposure either to one of those other three categories that you can only ever have your money in, which is physical assets, currencies, or bonds. And that's what's great. It's so simple. It's only 4 places you can have your money. So remember, really the point this week, the point I want to make this week is the higher the market goes, the more scared people are getting. And we're fortunate in that we have a couple indicators. Actually, we have a few indicators, 3 in regards to this podcast, that we can watch to tell us, should we start to scale back our equity exposure and potentially move it to another area? And I'll be doing that for you, and I'll be giving you updates in this weekend podcast. And guys, this is really just another step to help you really take back control of your money and your future, so you can have that security, you can have that freedom, you can have that knowledge that knowing you will have enough money. You guys have a great weekend, and I'll speak to you next week.